Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Hi, good morning again, everyone. Hope everyone had a enjoyable, relaxing mid-August weekend. Going to get started this morning. Got a lot to talk about. We've got a lot going on, both domestically as well as internationally. Going to speak about when, in terms of when is the best time to be most efficient and effective, and going to talk about financial markets. Talk about barons, talk about some sectors of the markets that have been laggards and perhaps represent opportunities. So this morning, wanted to start us out with something to think about, hopefully something that we all can utilize and something that we can incorporate into our thinking. Was reading a book over the weekend by Daniel Pink. The name of the book is When: The Scientific Secrets of Perfect Timing. And we are very focused as a society on how to do things, but something that we don't think about as frequently is when to do things and the effect that when may have over how successful we are when we do things, even after we learn how to do them. And we've heard references throughout our lives about when to do things. We've heard expressions like timing is everything. Miles Davis said timing isn't the main thing, it's the only thing. And time and when to do things is something that's interesting. It's something that perhaps is even Darwinian, built into our DNA. As we've lived on this same planet Earth, as our ancestors did, and our bodies have adapted to a clock, a 24-hour clock that has to do with the Earth spinning from day turning into night, and making that one revolution. And we as humans have adapted our lifestyles to it, whether we recognize it or not. Fascinating study talked about in this book 2 years ago. Two Cornell sociologists studied 500 million tweets from 2.4 million people from all over the world. And these tweets encompassed not just perhaps political figures here in the United States and business executives, but people from different countries, different cultures, different socio-economic backgrounds, people who were white, brown, black, people who are Muslim, Christians, Jews, and what they discover is that all of these people, regardless of where they're from, all had very similar markers indicating when they were most positive throughout the day and when they were most engaged. And what they studied for, these sociologists, was positive affect in those tweets, language that revealed that tweeters felt active, engaged, hopeful, and those feelings generally started out fairly elevated when people woke up in the morning, but more subdued. And then as the morning went on, people feel more positive, more engaged, more helpful, typically peaking at around 11 a.m. And then come mid-afternoon, sometime in the neighborhood of around 2 o'clock, those feelings plummet down, and people become more negative as the afternoon sets in. Typically sometime between 12 and 1:30 or 2 o'clock, and then those feelings typically linger until around 4:30. And then there is a marked increase in positive energy and positive feelings, and people start their moods re-elevating, and that generally starts in the later afternoon, and really the mood elevates and peaks up almost until bedtime. the highs that are typically experienced in the late morning, typically you don't see those levels again until around 8 o'clock in the evening. So what the takeaway here is that perhaps there is a period, let's call it sometime between 2 o'clock and 5 or 6 o'clock, when people are less positive, less engaged, less hopeful, and they are more positive, more engaged, more hopeful, typically between about 11 and 12, and from 7 p.m. on. Now, what effect does that have on us as investors, not just as individuals? And they took this takeaway, and what they did was they studied conference calls that were done by managers. And these are managers, keep in mind, that are highly incentivized to try and put the most positive spin that they possibly can on a conference call. These are highly trained professionals. But what they discovered, just judging by market reaction, and obviously, the prospects of the company all being factored into this, but what they did was they studied calls that were done in the morning, 9 to 10 a.m. versus calls that were done after the market closed at 4 p.m. And what they decided was that there was a very statistically significant difference in how the market reacted to conference calls that were done in the morning versus those that were done in the late evening. And this is despite the fact that they were done by highly trained professionals who all had a very strong desire to perhaps put a positive spin on their company, which sort of reinforces the fact that there are these truly diurnal, twice-a-day ebbs and flows that are built into our DNA, perhaps built into our evolution. So something to keep in mind. Also, there are times of the day when we are more capable of making not decisions, but perhaps reacting to our environment, and we react generally more positively to our environment, and are not quite as susceptible to certain thinking. And this is the type of thinking that we may want to do when our energy level, so to speak, or our positive affect is down. I'm going to move on to the financial markets, talk some more about when to do certain things at a later date, but wanted to leave you with that thought and those thinking here as you go about your day today. So, talking about the markets this morning, we are seeing futures significantly higher. We are seeing Dow futures this morning up about 280 points. We're seeing S&P futures up about 30 points. And we're seeing NASDAQ futures higher by about 90 points. Markets are extending their gains following positive trade chatter, lingering hopes that central bank policy can mitigate a global slowdown. Over the weekend, both President Trump and Director Larry Kudlow said that trade talks with China have been going very well. Regarding Huawei, President Trump said that it is a company the U.S. may not do business with, but he said he may decide on whether to extend temporary licenses today. That is something that he is expected to do. So if that is not what takes place, we'll see the reaction in the markets later in the day. Separately, the People's Bank of China said that they are aiming to reduce financing costs for businesses by reforming its interest rate system, something that is intended to help businesses in China. And perhaps more importantly, and perhaps having one of the greatest impacts of the morning, is Germany's finance minister out saying that Germany could spend an extra $55 billion in an economic crisis, this being reported by Bloomberg, and that sentiment from Germany, who is typically very fiscally conservative, being willing to spend in the event of a downturn, has propelled the European markets higher. The German DAX is up 1.3%, and most of the other European markets are up somewhere in the neighborhood of 1%. The Chinese market, in the wake of those comments on their interest rates, up over 2%. Other markets in Asia, the Nikkei in Japan, up 0.7%. The Hang Seng, where we saw very significant protests over the weekend, continuing, also up 2.2%. And South Korea's market up about 0.7%. Australia up about 1% as well. U.S. Treasuries this morning have declined notably, although yields in the last few minutes have come off, meaning prices not down as much as they were earlier. But nevertheless, Treasury yields are markedly higher this morning on the wake of this talk of stimulus from Germany potentially and China possibly doing something to reset their interest rates. Market participants this morning getting the feeling that central bankers are listening and perhaps would come to their assistance if things were to slow down. And therefore, we're seeing the 2-year Treasury yield up about 3 basis points to a 151. The 10-year is at a 159. That's about 5 basis points higher. And the 30-year is about 8 basis points higher at a 208 this morning. So seeing that weakness in the bond market after significant rallies the last few weeks. Oil largely unchanged, was up earlier. It's now up 19 cents. Gold is down about $16 in the wake of these higher interest rates. Currency markets very flat. Dollar is still around 111 to the euro, about 106.5 to the Japanese yen. Couple of stories this morning. Apple CEO Tim Cook warned President Trump about China's tariffs, saying that the effect of tariffs could be harmful to Apple and could benefit their competitor Samsung, who would not be exposed to tariffs. President Trump said that he felt that Tim Cook made a compelling argument against Apple tariffs. Against tariffs on Apple products, and Apple is up this morning on those comments, although nothing definitive. They're just comments at this point. Companies in the news: Empire Resorts, symbol NYNY, is going to be acquired by 2 international companies for $9.74 a share in cash. They operate some of the casinos in upstate New York. Some analyst comments this morning. Ares Capital, symbol Apple Roger Charlie Charlie, was upgraded to outperform from market perform at Bank of Montreal. The target was raised to 20. Amgen, which had moved up significantly the last few sessions, was downgraded to neutral from buy at Mizuho, although they did raise their target to 212. AMD, Advanced Micro Devices, was initiated with a neutral at Piper Jaffray. Moving on to Barron's this morning. Well, actually, before I do that, I'm going to just talk about some of the events that we have this week. Then I'll move on to Barron's, some of the things to look forward to. Fairly quiet summer week here in terms of the anticipated news flow. We do get some key earnings reports from retailers, Home Depot, Lowe's, and Target. We have on Wednesday this week as well, the Federal Open Market Committee releasing its minutes for its monetary policy meeting at the end of July. On Thursday, we have the Conference Board releasing economic indicators for July. That's expected to be up 0.3%. Then on Friday, we get new residential sales for July, see if the lower interest rates starting to have any impact. And then on Friday, we have Fed Chair Jerome Powell scheduled to speak in Wyoming at the annual Jackson Hole Economic Symposium, hosted by the Kansas City Federal Reserve. This is an event at which sometimes central bankers lay out more in-depth thinking with respect to their plans in the near future. So I mentioned Barron's. Barron's remaining fairly constructive or optimistic about the U.S. equity markets, despite some of the concerns we saw last week about inverted yield curve, potential for recession. And Barron's running a headline article on how to avoid a recession, cut interest rates like it's 1995. Barron's making comparison between the present day and 1995. Currently, in this environment, they say the good news is that the U.S. consumer remains healthy. Household spending is rising about 4% a year, its fastest pace since 2007. Worker pay is rising about 5% annually, which means growth is not dependent just on households taking on more debt. A little bit of a tinge to those clouds is that the bad news is that the strong wage gains seem to be coming at the expense of corporate profitability, which has likely contributed to some of the recent weakness in business investment. So what to do? Barron suggests take a look at the period in February 1994 to February 1995 when the Fed raised its benchmark short-term interest rate by about 3 percentage points to slow the economy and forestall the risk of inflation. At the time, Fed officials thought they were behind the curve because employment and output and spending all grew very rapidly throughout much of the early 90s, something similar to what we're experiencing today. But as that cycle progressed, the difference between yields on 2- and 10-year treasuries collapsed to almost nothing. Again, something similar to what we're seeing today. And then by the summer of 1995, the Fed said that they believed that they had overshot. And what they did is, over the next few sessions, they responded by lowering their policy rate, and they cut rates by 0.75% over the next 9 months. And the recovery ended up lasting another half-decade. Barron's saying that with appropriate Fed action, that perhaps we could see a repeat of what took place in 1995. Obviously, a lot of uncertainty there. No guarantee that the Fed will even continue on the rate cutting path. But that is what Barron's is suggesting would make sense, at least at this moment. A couple of other stories, headline stories in Barron's had to do with Wall Street abandoning oil and gas stocks and saying that you, the individual investor, should not. Barron's pointing out that energy stocks have rarely been this unloved. They recognize that on the surface, the case for energy stocks has worsened in recent months as the escalating U.S.-China trade war and other geopolitical disruptions have heightened concerns about global growth and energy demand. U.S. oil prices fallen to around $55 a barrel from $66 in April. Natural gas getting hit particularly hard, down more than 25% to its lowest level since 2016. The SPDR S&P Oil and Gas Exploration ETF, X-Ray Oscar Paul, has touched a record low earlier this month. It's off about 20% this year to about 21%. The weighting of energy in the S&P 500 has dropped below 5%, its lowest level in over 40 years. Energy represented 13% of the S&P 500 in 2008. Now, with Wall Street abandoning the sector and seemingly capitulating, the group may be bottoming out. They say many industry players are responding to investor pressure to rein in capital spending, curb supply, boost returns, and pay out more to shareholders in dividend and stock repurchases, suggesting perhaps the best answer to low oil prices is low energy prices, meaning that the demand continues to slowly ebb higher, while supply slowly gets cut off as the prices go lower, and it's not as profitable for some producers to continue going. As a result, Barron's points out investors can get dividends in this yield-starved world above 6% on companies like Royal Dutch Shell and British Petroleum, ExxonMobil yielding over 5%, Chevron Texaco yielding over 4%. Article suggesting that oil is not going the way of, let's say, tobacco, and is not going away in terms of consumer demand anytime in the near future, according to the authors of this article. They talk about the fact that over the past decade, energy has returned only 4.4% versus the S&P 14% returns, and this is something they say has really turned investors off, which they say perhaps creates an opportunity. ExxonMobil anticipates that despite the fact that more people will be driving electric vehicles, nevertheless that oil demand will continue to rise for the next 20 years, the next 2 decades, and that's because increases in consumption trends, population growth, and perhaps the biggest reason is that living standards in the developing world will continue to rise, and those people are going to require more air conditioners, more energy to power their homes, their computers, and yes, some of them will be riding in electric vehicles, but that will be offset by the demand coming from other sources. Chevron also estimating increased demand and estimating that that energy companies will have to spend $10 trillion through 2040 just to replace the reserves that are going to be used up in the next 20 years. A couple of other stocks that Barron's suggests considering. I'll talk about the oil servicers and drillers, Schlumberger, symbol Sam Lucky Boy, and Halliburton. Barron's saying both stocks look attractive as these company executives rein in capital spending, boost free cash flow. Halliburton, HAL, is trading at around 14 times 2019 depressed earnings. Schlumberger is at around 32, around 20 times depressed earnings. Schlumberger executives have expressed confidence in the company's $2 a share dividend, which provides yield of more than 6%, and Halliburton is yielding more than 4%. I'm going to switch here to a retailer, another sector that is out of favor, obviously, with concerns about Amazon, the internet, and the changing consumer consumption habits. But China, we'll talk about China in this article, but Barron's positive on American Eagle stock, symbol Apple Eddie Oscar. And the real impetus here for the bullishness on AEO has to do with their line of clothing called Aerie, A-E-R-I-E. And what Aerie is it is a line of clothing that embraces undergarments, not just for models, but for people of all sizes and shapes. And American Eagle has been gaining lots of market share with this line. They're now the number one women's jeans brand in the United States. They are number one for men ages 15 to 25. And this is because of those products I mentioned, body-positive products, including an extensive range of jean sizes, as well as an array of cuts for a variety of figures, including curvy jeans, high-waisted leggings, mom jeans, flare jeans. And as a result, quietly, American Eagle has enjoyed 23 consecutive quarters of record jean sales. Aerie's Intimates now has 115 standalone stores, and American Eagle, as a result, is one of the fastest-growing retailers. Aerie sales hit nearly $650 million last year. That's up 29% from the previous year. And by deeply associating with the body positivity movement, Aerie has stolen consumer mind share from competitors like Victoria's Secret. Quote one analyst here who's looking for earnings in the neighborhood of $2 a share next year. The stock currently is trading at around 14, so if that analyst is correct, it's trading around 7 times forward earnings. The dividend yield for AEO is 3.7%. The company has more than $2 a share in net cash, and it is buying back stock. This analyst suggesting the stock over the next 18 to 24 months could nearly double to $30 per share. Another article in Barron's, and this is something relevant to all investors, talks about how brokerage firms like us here at Lanton Investments use sweep accounts, and how some of these firms cash in on your desire for convenience. Many firms now, many brokerage firms are paying to customers sweep yields or yields on what used to be known as money market funds, rates anywhere from 5 to 15 or 20 basis points. Brokers that have eliminated money markets for cash sweeps are Charles Schwab, E-Trade, Edward Jones, LPL, Bank of America, Morgan Stanley, and TD Ameritrade. And as a result of eliminating those money market sweeps, what they've done is oftentimes replace them with FDIC insured sweeps, but they have replaced those sweeps with significantly lower interest rates. So after the most recent reduction in the Fed funds rate on August 1st, companies like E-Trade dropped their yield on sweeps for cash balances to 8 basis points from 15 basis points for accounts between $100,000 and $250,000. Morgan Stanley trim rates for all accounts under $1 million. At Merrill Edge, the discount brokerage division of Bank of America Merrill Lynch, sweep yields are down to 5 basis points for accounts with balances less than $250,000. I will say if you're focused on us here at Lanton Investments, sweep yields are significantly higher. We still continue to offer money market rates, and depending on the sweep option you choose, you may see rates anywhere in the neighborhood of 1.5%, which stacks up favorably with lots of the rates we're discussing here this morning. In fact, if you look at a company like Charles Schwab, they make most of their money now off of the interest income from reinvesting customer cash. Of the $5.4 billion in revenue in the first 6 months of 2019, $3.3 billion of it was from net interest on cash. So you can see that cash is becoming increasingly big business. Some firms have markedly dropped the rates that they pay on those sweep accounts, and that translates into a significant uptick in the revenue they earn from these products, and they have done that partially to offset the lower revenue they're bringing in from trading and execution as they've dropped the prices for those services. Article on General Electric. Some of you may have been following General Electric last week. We still have lots of investors out there that own General Electric stock. General Electric last Thursday sank 11% after noted whistleblower Harry Markopoulos alleged fraud in the company's long-term care insurance business. GE responded by claiming market manipulation. And after the event, we had news that Larry Culp, the CEO of General Electric, bought some additional stock over 2 days in the past week. So Larry Culp putting his money where his mouth is, so to speak. He paid $3 million for about 330,000 shares on August 12th. That's an average price of just over $9. And then 2 days later, he paid $2 million for 252,000 shares. Average price just over $8 on that second purchase there. Also, GE's chief human resources officer bought about $1 million of stock on August 13th in the high nines, about $9.80. And Tom Horton, who joined GE's board last year and succeeded Larry Culp as lead director, he bought GE stock as well. He's the former CEO of American Airlines, and he bought about 500,000 shares at $9.02. These insiders saying that the purchases reflect their confidence in GE's long-term strengths and its progress. So we'll see how this tug-of-war continues to play out. Important to keep abreast of what's taken place and what the news is and what impact it will have there at General Electric. Finally, a couple of words on the bond market, the muni market. Article on the Bloomberg, and Bloomberg this morning saying that according to Bank of America Merrill Lynch, that negative muni yields seem unlikely, and the reason that they come to that conclusion is that one of the biggest benefits of municipal bonds, tax-free bonds over other investments, is the fact that you do not have to pay taxes to the federal government and many times to state and local governments on municipal bonds. If you had negative yields, that benefit wouldn't be relevant, and therefore they feel that negative rates would make even less sense for municipal bonds than they make for non-municipal bonds. Also this morning, California was upgraded by Fitch rating service. California General Obligations bonds upgraded to AA at Fitch from AA-. Fitch now rating California General Obligations slightly higher than Moody's and S&P. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.